Hello, and welcome back to Chapter 9, Fundamentals of Capital Budgeting. Hi, I am Dr. Moultrie, and we are continuing our discussion on the fundamentals of capital budgeting, Part 2. This is Part 2. As we discussed in Chapter 2, there are important differences between earnings and cash flow. Now, earnings include non-cash charges such as depreciation, but do not include expenditures on capital investment. So to determine a project's free cash flow from its incremental earnings, we must adjust for these differences. As I previously mentioned in Part 1, depreciation does not represent a cash outflow for the firm. Rather, it serves as a means for distributing the original asset cost over its useful life for accounting and tax purposes. Although depreciation is not a cash flow, it is integral to our tax liabilities. By reducing taxable earnings, depreciation impacts our cash flows indirectly through tax savings. Therefore, we must include depreciation by adding it back to incremental earnings to accurately reflect its effect on cash flows. For instance, let's look at Table 9.1, deducting and then adding back depreciation. So we have a project with an incremental gross profit of $1 million and a $2,000 depreciation expense. If the firm's tax rate stands at 20%, the incremental earnings would amount to what? 1 million minus 200,000 times 1 minus 0.20, which will give you $640,000. However, the actual cash flow remains $840,000 because the $200,000 depreciation expense does not represent a real cash outflow. So here again in Table 9, it outlines the computation to determine the incremental free cash flow in this scenario. The blue boxes highlight all the actual cash flows in the correct column. A reliable method to verify the accuracy of the incremental free cash flow is to sum up the actual cash flows. In this instance, the firm accrued $1 million in gross profit, which is a positive cash flow. It paid $160,000, as you see here, the negative $160,000 in taxes, which is a negative cash flow, which results to 1 million minus 160,000 equal your $840,000, which corresponds to the incremental free cash flow. Now, to your right in the incorrect column, we demonstrate the outcome if if depreciation were entirely disregarded. Owing to the inflated EBIT, taxes would also be overstated, thereby leading to a lower incremental free cash flow. So it is worth noting that the $40,000 difference between the two scenarios solely arises from the variance in tax payments. Here we have a problem. Now let's return to HomeNet example. In example 9.1, we computed the incremental earnings for HomeNet, but we need the incremental free cash flows to decide whether Cisco should proceed with the project. Now remember, this problem was discussed in part 1 of chapter 9's video. So the solution plan, the difference between the incremental earnings and incremental free cash flows in the HomeNet example will be driven by the equipment purchase for the lab. We need to recognize the $7.5 million cash outflow associated with the purchase in year 0 and add back the $1.5 million depreciation expenses from year 1 to 5, as they are not actually cash outflows. To execute, here you see a table. The years and the corresponding amounts are what you see here in table. Let's go to your left. You see the year, right? Starting at 0, going to your right. Then you have the first year, second year, the third year, the fourth year, and the fifth year. Okay. So in year 0, sales, cost of goods sold, gross profit, selling, general and administrative depreciation, EBIT, income tax at 20%, incremental earnings, and add back depreciation, they are blank. They are blank. Okay? But in year 0, you see the purchase of equipment at 7.5. In year 1, you see sales at 13,000, cost of goods sold negative 5,500, gross profit 75, selling, general and administrative a negative 2.8, depreciation negative 1.5, EBIT you have 3.2, income tax at 20%, then you have a negative 640. You have incremental earnings at 2.560. You add back depreciation at 1.5. Purchase of equipment, blank. Then you have your incremental free cash flows at 4.060. And then you see for the second, third, fourth, and fifth year periods. To evaluate, by recognizing the outflow from purchasing the equipment in year 0, we account for the fact that the $7.5 million left the firm at that time. By adding back the $1.5 million depreciation expenses in years 1 through 5, we adjust the incremental earnings to reflect the fact that the depreciation expense is not a cash outflow. Here we have another problem. Let's return to the IOTA example in example 9.1a. We computed the incremental earnings for IOTA, but we need the incremental free cash flows to decide whether Abbey Fan should proceed with the project. Again, this is a problem from the previous video in part 1, but we're returning to this example. The solution plan. The difference between the incremental earnings and incremental free cash flows in the IOTA example will be driven by the equipment purchase for the lab. We need to recognize the $6.5 million cash outflow associated with the purchase in year 0 and add back the $1.3 million depreciation expenses from year 1 to 5, as they are not actually cash outflows. Here you see a table where we're executing. So it's the IOTA project incremental free cash flow in thousands. You have year 0 through 1, 2, 3, 4, and 5. And then as you see in year 0, all of the lines are left blank except the purchase of equipment, which is at a negative 6.5. In year 1, you have revenue as 8,000, cost of goods sold, negative 3.6, all the way through year 4. You see the gross profit at 4,400. Year 1 through 4, then you have a negative 2,000 for selling, general, and administrative from year 1 through 4. And depreciation, you have a negative 1.3 from year 1 through 5, and so forth and so on. By recognizing the outflow from purchasing the equipment in year 0, we account for the fact that the $6.5 million left the firm at that time. By adding back the $1.3 million depreciation expenses in years 1 through 5, we adjust the incremental earnings to reflect the fact that the depreciation expense is not a cash outflow. Another way that incremental earnings and free cash flows can differ is if there are changes in net working capital. Now, we defined net working capital in chapter 2 as what? The difference between current assets and current liabilities, right? Yes. It is the difference between current assets and current liabilities. Now, the main components of net working capital are NWC. You'll see those, you'll see the acronyms later. The main components of net working capital are cash. You have inventory, receivables, and payables. So the net working capital is equal to current assets minus current liabilities equal cash plus inventory plus receivables minus payables. The disparity between receivables and payables delineates the net capital utilized by the firm through credit transactions. Another word for credit transaction we call trade credit. Trade credit. So net working capital is significant as it mirrors a short-term investment, restricting cash flow that could be allocated elsewhere. We define the change in net working capital in year T, the letter T, as change in net working capital in year T equal NWC subscript T minus NWC subscript T minus 1. So you see in year 0, you have the level of incremental NWC at 20,000. Change in incremental NWC, you have a positive 20,000. Cash flow for change in NWC, you have a negative 20,000. Change in incremental NWC, you see 0 for year 1 and 0 for year 2. But in year 3, you have a negative 20,000. Then you have cash flow from change in NWC. Year 0, you have a negative 20,000. Year 1 and 2, you have 0. But in year 3, you have a positive 20,000. Problem. Suppose that HomeNet will have no incremental cash or inventory requirements. Products will be shipped directly from the contract manufacturer to customers. However, receivables related to HomeNet are expected to account for 15% of annual sales, and payables are expected to be 15% of the annual cost of goods sold. 15% of $13 million in sales is $1.95 million, and 15% of $5.5 million in cost of goods sold is $825,000. HomeNet net working capital requirements are shown on the table on the next slide. And here you see it. You have year 0 through 5. 1, 2, 3, 4, 5. Net working capital forecast. It's blank. You have cash requirements. 0 for year 1 through 5. Inventory 0 all the way through. Receivables 15% of sales. For year 1 through 4, you see it at 1.950. But year 5 is at 0. Payables at 15% of COGS, cost of goods sold. Year 1 through 4 is a negative 825. Year 5 is 0. So the net working capital for year 1 through 4 is 1.125, or 1,125,000. How does this requirement affect the project's free cash flow? How does this requirement affect the project's free cash flow? Any increases in net working capital represent an investment that reduces the cash available to the firm and so reduces free cash flow. We can use our forecast of HomeNet's net working capital requirements to complete our estimate of HomeNet's free cash flow. In year 1, net working capital increases by $1.125 million. This increase represents a cost to the firm. This reduction of free cash flow corresponds to the fact that in year one, $1.950 million of the firm's sales and $0.825 million of its costs have not yet been paid. Have not yet been paid. So the plan in years 2 through 4, net working capital does not change, so no further contributions are needed. In year 5, when the project is shut down, net working capital falls by $1.125 million as the payments of the last customers are received and the final bills are paid. We add this $1.125 million to free cash flow in year 5. So as you see, during years 2 through 4, there is no alteration in net working capital. However, in year 5, upon the cessation of the project, net working capital diminishes by $1.125 million due to the receipt of payments from the last customers and settling of the final bills. Now, this $1.125 million is then included in the free cash flow for year 5. So the incremental free cash flows would be what you see here. And I'll just leave it up here for a moment for you to review. I'll just read some of it. So year 1 through 4, the sales is at 13. You have the cost of goods sold at a negative 5.500. Then you have a gross profit of 7.5 for years 1 through 4. And then the depreciation, which you see on line 6, you have a negative 1.5 for years 1 through 5. And then you have your EBIT, years 1 through 4 at 3.2, but then in year 5, you have a negative 1.500. The free cash flows differ from unlevered net income by reflecting the cash flow effects of capital expenditures on equipment, depreciation, and changes in net working capital. Note that in the first year, free cash flow is lower than unlevered net income, reflecting the upfront investment in equipment. In later years, free cash flow exceeds unlevered net income because depreciation is not a cash expense. In the last year, the firm ultimately recovers the investment in net working capital, further boosting the free cash flow. And this is the end of this lecture.